Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. We're going to be going over Twitter again. I'll be looking at what's being shared in the news, give you my financial opinions of what I think's going on and the reasons behind it. And again, if you want to partake in our community, check out finding-value.com, Platinum membership. All right, so let's dive in here. Let's see what's going on with Twitter and the stuff I'm sharing. Peter says global stagflation is the rocket fuel for gold and silver prices. I would tend to agree. So the big boom in gold and silver was in the 1970s. The 1970s in 1970, 1970, we had peak oil in the United States. The gold and silver boom was that stagflationary. It's basically money being created in the system at a faster pace than GDP, and oil was limiting some of that growth. I think that's going to happen on a worldwide scale, not just in the United States like the 1970s. So when that happens on a worldwide scale, it is going to be glorious for some assets and absolutely horrible for other assets. During that time frame, gold and silver mining companies, they did very well. Same with oil. Oil was one of the other assets that did very well, and uranium did as well, even though we were in a massive surplus of uranium. So let's look at this. It says, or here we can read it from here. The Great Stagflationary Debt Crisis. It says, combining some of the worst elements of the 1970s with the global financial crisis, now we're facing the perfect storm: inflation, recession, stagflation, and a potential debt crisis. The debt ratio in advanced economies was only 100% of GDP in the 1970s. Today, it's 420% of GDP in private and public debt. So in this case, if we have those shocks to, say, oil prices, not only do you get inflation, not only do you get a recession and stagflation, but you get what I call a great stagflationary debt crisis, because with interest rates so high, then that of the debt ratio has become unsustainable. Unsustainable. And keep this in mind, because I'll make some comments later on this as well. It says U.S. consumer savings rate as a percent of disposable income ticking back up this cycle is going to be the graveyard of many macro pros and tourists alike. So this is the U.S. consumer saving rate as a percent of disposable income is increasing. What is going on there? So that's different than what a lot of people think is going to just go straight to this crisis, foreclosures, complete deleveraging that everyone is forecasting. But it looks like the market is a lot more resilient than what most people are giving it credit for. It says, bad news for the QE deniers. Liquidity continues to rise strongly. The markets appear to agree. This is US dollar liquidity. It peaked sometime in middle of 2022. It's come back up, and we've had the surge of liquidity, US dollar liquidity in the markets. And I think that's kind of a surprise for a lot of people. Coming on in here, oil market says, and we're back with SPR sales. According to preliminary DOE data, 400,000 barrels flew out of the reserve last week, 57,000 barrels per day. The U.S. government plans to sell 26 million barrels in the next few months as part of a disposals mandated by Congress a few years ago. And it just so aligns with the cuts that OPEC has put in place. So maybe they're counteracting any of this, these barrels being thrown on the market. It says the Fed is going to hike until something breaks. The U.S. Treasury is going broke as tax receipts income continued to plunge, down 10% year over year in February. The weird thing is, maybe the Fed is going to break the Treasury. I just thought this was kind of funny to read it. As interest rates go up, we have higher and higher interest payments. The actual, America does, the Treasury. And Maybe the thing they break is the Treasury itself. But all it's going to do is break its way into more inflation as the deficits grow, and they're going to print money to cover those debts. It says, long overdue, optimism has finally run down to be replaced by declining earnings many months into the future. This time, no Fed put. Deflation will take down stock markets along with all their assets retaining value until now. This is what he says. It says earnings are now contracting across all U.S. indices. Correct. I do not think that the deflation will take down the stock market. It's going to be inflation, and it's going to be tightness in oil and other markets where money is going to rotate to solve those problems. The problem is it's going to rotate away from things that people don't need and rotate towards things that people need in order to survive. So it's going to go towards energy, food, housing, those types of things. It's going to go away from Netflix, other things that are out there that are technology related, maybe iPhones or something like that. Coming on down, more banks could see their reserves run empty like Silicon Valley Bank, warns JP Morgan. JP Morgan says more banks could run out of reserves like SVB if the pace of this deposit flight continues. Or are they just trying to scare you out of your shares? I don't know. Here's Mike. He says, by April 1st, 2020, we could see the first surprising signals of housing demand in the data. This year is surprising too, not as dramatic, but still. Currently, only 30.5% of the market has had a price cut. Big change from quarter 4. It says, surprising demand is being met with limited supply. Only 410,000 single-family homes on the market, down almost 1% from last week. The further into quarter 2 we go without substantial inventory increase means it's less likely that we'll emerge from our shortage this year. This is our inventory levels remaining very low. Frankly, very few sellers, only 66,000 new single-family listings this week. 16,000 of those are already in contract. There's just no sign anywhere in the data that inventory will surge. Maybe if a recession hits hard, but that's starting to look like 2024 supply. Median price for single-family homes is now $437,500. The median price of new listings this week is $400K. That's 4% lower than last year. Home prices are ticking up. The comparison from last year is getting worse as prices are still shooting higher. Here is median home price as we go, as we're shooting on up. The price of the pendings is $375,000. That's 1.3% lower than last year. Again, this shows us that prices are not falling, but the year-over-year comparison will get worse for the next few months. The headlines will report negative HPA for several months. And that's what I was talking about. The median price of homes from March onward could go down on a year-over-year basis. So here's all the details that he's going to share. So coming on back. This is the list of the countries that have announced that they would be cutting oil production. Saudi Arabia, Russia, Iraq, UAE, Kuwait, Kazakhstan, Algeria, and Oman. Total is 1.6 million barrels that we're cutting per day. So it looks like the squeeze is going to be put on oil. Will this be sustainable? If these guys hold their production cuts, I think it's going to get kind of squeezy out there pretty quick. We should see inventories worldwide start to draw down some, which will push oil prices higher. Is this going to be the start of the big move? It very well could be. Obviously, no one knows for sure, but I can tell you if they tighten the markets up, I would suspect that prices go higher. Michael says, COMEX silver drain continues as 640,000 ounces withdraw, over 5.4 million ounces in the last 8 trading days. Register was unchanged. Open interest is now equal to 219% of all vaulted silver and 1,710% of registered silver. Here's 17% of people who purchased a car during Q1 of 2023 have a monthly loan payment of $1,000 plus, the highest share on record. So there's more car payments top $1,000 a month. All these here in terms of percent, over 16, 17%. That's a lot of money if you think about it, $1,000 a month for a car payment. My mortgage is about that payment. That's ridiculous. It says 2007 active listings over 4 million with significant distressed sales in the works. 2023, 980,000 active listings with 30 to 90 delinquencies data near all-time lows. If you're running 2008 housing models without adjusting to new credit models, then it's like, what the heck is going on here? The data doesn't align. 2007 had active listings over 4 million with a bunch of distressed sales. 2023, we had 980,000. That's a quarter of active listings of what we had in 2007. And then, yeah, this is back with copper, so I won't go over that. But that's what I've got for today, guys. I don't have too much. So the real estate market's holding together quite fine. We just don't have any inventory of it. I know a lot of people say, oh, I made comments that the housing market would not go down with inventory less than 6 months. That did occur. I am wrong with that outlook, and it is the first time in history that that has occurred. That we've had inventory less than 6 months, and we had a down or pullback on a year-over-year price basis. I said that was most likely not going to occur. I was wrong in saying that. So I'll admit it, I'm wrong in that statistic, but inventory is still very low. So that is an anomaly, and we have market conditions that have never been seen before in the history of our markets. Looking forward, yeah, oil's tightening up. Oil's going to look pretty strong. I think gold's going to look pretty strong. And we didn't talk a lot about gold and silver here, but yeah, I think inventory is going to continue to draw. There was another question that someone had that I'm going to kind of answer here real quick. Someone asked me about, I was talking about ratio swapping metals, one metal for another metal, and doing that directly. And I said that there was no currency risk. What I meant by currency risk is when you have stocks, equities. So you're in your money's in the stock market, and you've got stocks of oil and gas or whatever it is. You go to sell those. How do you get out of the trade? If you've got a really weak currency that just the currency is falling rapidly, you can't get out of those trades. So you get out, you sell, and you sell into what? Currencies. Then your money has to clear, takes 3 days or whatever, 3-4 days. Then you got to transfer it to a bank, and that takes a couple of days, and the money has to clear. And all of a sudden, you're a week or 2 weeks into all this time that is going to be money to be cleared. Now, here's a question. What if the physical markets get really, really tight? So you've got that risk of, I call that currency risk. You're subjecting yourself to currency appreciation and depreciation over time with that money transferring over a week or two out of that brokerage account or whatever it is. If you're in the metals themselves and you're swapping from metal to metal, you don't have to wait for that currency to clear. You don't have that currency risk. You can go from one to the other immediately and directly. So that's what I meant by currency risk. The currency risk is that you have to transfer into a currency for a week or two, at least. I would say at least a week, and then transfer it to something else. Then you've got the risk that you may not have the metals there to buy at some point. And I don't know if that's going to exist. I don't know. But if the markets get tight enough, we could see a run on the markets from the retail sector and then eventually from the industrial sector. Because industry needs this, they need this stuff to run their production. So they might go out and buy mines. They might go out and buy inventory. Who knows what they're going to go out and buy. And they've got a lot of money, and they're going to probably fight each other for that inventory. But there is risks associated with not being in the metals. Because now you're going to subject yourself to currency no matter what. You can't get out of that trade without transferring through a currency. And that's what I mean by currency risk. Because if you've got a currency that is dive bombing, what are you going to do? Are you going to sell your assets out of a brokerage account and try to transfer it out while the currency's tanking 20% a day or whatever it is? That's what I meant by it. But that's all I've got, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like to join our community. And we do have, again, 5 p.m. Mountain Standard Time, Platinum question and answer session coming up on the weekend. See you there. We'll catch you next time. This is Finding Value.